Good morning, everyone. This is Ben Ryan, and welcome to the Hedgeye Morning Macro Show for Friday, June 24th, 2016. I will touch on the asset allocation and hand it right to Keith. Well, we will hear from Daniel Liquidity, European strategist. This should be a great discussion this morning. There is a little bit going on, so we'll hit on try to cover most of it. This should be a great show. Cash was reduced to 57% from 61% yesterday. U.S. equity exposure at 0%, excuse me, from 3%. International equity exposure flat at 0%. Commodity exposure was taken up to 13% from 12%. Foreign exchange taken up to 5% from 3%. And fixed income exposure is now at 25% from 21% yesterday. Looking at those exposures as a percentage of our preferred max exposure to each asset class, cash is at 57%, U.S. equity exposure at 0%, international equity exposure at 0%, commodities at 39% of the max, foreign exchange at 15%, and fixed income is at 76%. With that, take it away, Keith.
Thanks, Ben, and good morning. For those of you that are new, and thank you again for those of you that are new to tuning in, that asset allocation decision is crystal clear. We've had this same view for a long time now. We do think that growth slowing is the tail wagging the dog, whether it be in the UK or otherwise, and back in this country as well. This is a real vote. It's a great day for democracy. It's a great day for free market liberties. A lot of us thought that we wouldn't have those anymore. Obviously, you could see that there is mark-to-market risk in a lot of asset classes. There are alternatives to stocks. We would love to buy stocks lower. Again, what we signaled yesterday in real-time alerts was crystal clear. It was a sell signal in SPY. It was a buy signal, which you can see in commodities relative to the position that we have. It's mostly gold, and again, on the long bond, which has been our best idea for a year now. What I'm going to do is go through what we do every morning, which is the top 3 things in my notebook. It's pretty easy to get through this morning. Then I'm going to get to, again, my friend and colleague, Daniel Liquidity, Liquidity has done as much as anybody's done in real markets, and that's a real big deal. He worked at Citadel. He was a portfolio manager there. I was a portfolio manager at Magnetar. We aren't these spewing economists who have never actually played the game. We're actually economists and strategists who are playing the game that's in front of us as opposed to the one that we want. And there's a big difference between that and what you could get on any cable TV channel right now. So first, top 3 things in my notebook. Number 1 is the pound. Number 2 is the stock markets worldwide. And number 3, bond markets worldwide, which are obviously continuing to signal that they've nailed this. Literally, who nailed this? Mr. Macro Bond Market absolutely nailed that there was a lot more risk than people were pricing in. So first, on the pound, I mean, this is basically the most epic move, arguably ever in modern times for obviously the British currency, but really the biggest down move since 1992, which was called Black Wednesday. This is what is now going to be called Black Friday. So again, Black Friday in UK pound terms, because the pound is getting pounded. A lot of people have thought over a long period of time now that a strong currency is a bad thing. This metaphorically reminds you that a weak currency is a bad thing. If it wasn't a bad thing, why would the pound be going down? If it wasn't a bad thing, why was the pound going up in anticipation of a good thing, i.e. a non-Brexit? So again, I think it's a really important day for that. That point is one that we've made many, many times, which is if you have a bunch of central planners in an unelected territory like the Eurozone trying to centrally plan people and their purchasing power, i.e. their currency, the value of that hard-earned currency, you will have a revolt. It may not happen, very, very quickly, but sometimes it happens all at once, and that's the main point on the pound. Point number 2, stocks. You know what? Stocks have been crashing in Europe year to date. This is just a continuation of what you should have been positioned for. It's the same thing in Japan. Japanese stock market's down over the 20% since July of last year. You can see down 28%, including the 8% decline this morning. We've seen a German stock market that opened down a full 7%. That's down 23% versus where European growth peaked last year. A lot of this has to do with the cycle. A lot of this has to do with what you could have readily seen happening in front of you all along. Don't wake up in the morning turning on a television channel that navel gazes at the Dow Jones Index and completely misses the global macro picture. What has been happening is continuing to happen. This is a legitimate crash in European equity markets. Italian stocks up until today were down 27% from where you could have bought them last year or gotten plowed into that kind of stuff. They're down 40% now. This is not going to end today. This is a big domino. Daniel hopefully can help me explain that with a little bit more specificity in terms of what dominoes may fall next or which may not. This is going to be a very confusing, and again, it's going to breed a lot of contempt. It's going to do a lot of things that people, you could see right now, futures don't indicate down 70, 80 handles if people don't have some confusion and contempt breeding right now, if you will. Finally, bond markets. This is where you've been paid big time. If you've understood growth slowing, you've been long the long bond. Don't have somebody wave an American flag at me telling me that it's patriotic to buy American stocks. Why not American bonds? Why don't you own bonds? Why don't people wake up every day marketing why you should be long safety? Again, safety, I haven't been a gold bull for 3 years. We're long gold now. Again, go both ways. Understand there's a time to buy stocks. There's a time to buy bonds. Today's not a generational buying opportunity in stocks. Today is a day to give thanks that you weren't long stocks. Today's a great day to be long bonds. New all-time lows again. That's been our call in the 10-year bond yield in the U.S. Again, you can see that now 1.52%. Again, you can see the red arrow. That's a trend, okay? The trend has been your friend in the face of multiple rate hike expectations, hopes and beliefs that the belief system that is the Federal Reserve could hold this up. Understand, again, hold up interest rates, hold up growth expectations. This has broken. This is the day to remind yourself what has been happening all along. Mr. Macro Market on the bond market side has absolutely nailed this. We're seeing a big decline in German 10-year bond yields. They're now at negative 10 beeps. We've obviously already seen a decline in something like the Spanish 10-year, but we've seen these declines across bond yields worldwide. What do they do next? That's the question. That remains the question. And maybe the question, and a good time to bring in, again, my friend Daniel Lacalle to help me answer this, because they're going to come out, Daniel, today, and they're going to do something. I think they said Jean-Claude Juncker, who's the president of the European Commission, we're going to have councils and commissions and bureaucrats. We're going to come, and I think they're going to say that they're going to do something else. But what happens, Daniel, if what they do doesn't do anything at all for macro markets?
Don't worry, we'll have a summit. Huh? This is the message. The message is that the European Central Bank, Bank of England, will get together and will provide unlimited liquidity. Unlimited, mark the word, and that they will have a summit. But the issue remains. The issue that remains here is that you have a Eurozone that is so fragile that even a country that is allegedly not linked to Europe, that is, if you go to many European countries, they will say that the UK has completely severed its ties from the European project, that they have their own currency, their own legislation, etc., creates this. Because the funny thing from all of it is that what is showing is that the risk of contagion is much higher than what markets were anticipating. Everybody was relying on the absolute power of the European Central Bank to fix everything. And governments have been relying on monetary policy to solve the issue of stagnant growth, of unemployment. And obviously, it isn't working. It isn't working. Brexit is the proof that what we've had for so many years, or what we've been saying for so many years, you and I, many others, that the European Union cannot be constructed as an ostrich that puts its head on the ground and waits for the world to move towards it. That's the problem. And unfortunately, and that's where I completely join with you in the trade idea, is that the solution will be to get things worse, will be to further increase interventionism, further move towards the French dirigé, the directed economy, and we forget everything that's important, which is productivity, which is competitiveness, which is the position of the European Union in the world market, and the opportunities to create jobs and to create investment opportunities. All of that is being left behind in the discussion.
Well, it's interesting. I mean, if you are the ostrich indeed, and you're Jean-Claude Juncker or whatever his name is, I mean, at the end of the day, you got a Belgian guy who speaks like a Frenchman starting to tell the world that today, if you're out, you're out. There will be ramifications. These guys have decided to come out this morning. The Fed, by the way, is like, as we're talking, of course, Janet Yellen is going to provide unlimited liquidity or something like that too. This is really the belief system coming to its apex point, is it not? Where they actually have to say that they're going to play, their hand is out of cards. They have to come up with a new hand. What happens if everybody's out?
Well, first let's start with what is the new hand, because the problem when you have a belief system and reality kicks in, you need to come up with something magic. No? If you remember, Shinzo Abe came up with Abenomics, which had to add a Q to QE because after 6 stimulus plans it didn't work, so they had to put something different. It had to be another Q, quality. It didn't happen, obviously. What is the problem? The problem here is that the issue of the European Union is not one of liquidity. Excess liquidity at the European Central Bank, as we speak, exceeds 800 billion euros. So there's no problem of liquidity. There's no problem either of support from the European Central Bank, because it's buying not only sovereign bonds, but it's also buying corporate bonds. So it's not about monetary policy. And the problem is that the new hand is likely to be very similar. It's going to be another stimulus plan, and I'm afraid it'll be a helicopter money stimulus plan. So something that sort of makes it seem like different.
It's the fears are pervasive. You know, when you think about this from an investor's perspective. Maybe we can show this chart I was tweeting about. I was trying to show it real time, if only because nobody in mainstream media tweets the real time data. I mean, God forbid we actually look at the data that's driving all this. But today, Daniel, obviously in the U.S. we still have to report the data, unfortunately, and you can see that capital goods orders, CapEx, is, you know, for the 16th month in the last 17 is negative year over year. You know, obviously it's in a recession. The decision makers that can choose to either lever up to buy back their stock or to actually invest and hire people and to take on some risk, I mean, that chasm is wide open. We're here at this point now where durable goods orders, for example, that was obviously part of the durable goods report, that was down 2.2% sequentially. Wall Street's like, oh my God, that missed. Oh, wasn't that because of the Brexit? No, you can't just go to the Brexit. The Brexit just happened, guys. And by the way, you were long that they wouldn't Brexit. So, you know, we're at this point now where I think that's really the question. I was just on the phone, as I talked to you before this show, with one of the biggest CIOs in the world. And he asked me, he says, what does this look like if you're trying to think about actually investing in Europe in the next 3 to 5 years? What does this mean? What does this place look like? And I got to tell you, Daniel, I had no idea how to answer the question.
Okay, it's a difficult answer, obviously, and you're absolutely right to have it. It's a difficult way of finding a solution. Why? Because too many things have been opened. This is the Pandora's box conundrum here. The most likely scenario will be that the European Union will choose to shield together and to soldier on in a similar way to what they did in 2009. In 2009, if you remember, with the financial crisis, etc., the European Union decided to make a very strong case about stimulating the economy through fiscal spending and by increasing massively government spending. That is very likely to be what happens. Mm-hmm. However, for all these things to happen, including the possibility of a Eurobond issue, you need to change the ECB mandate. You need to get the Germans to agree. You need to make countless, because it'll be at least a year of summits in which first you need to get the presidents together, then the finance ministers together, then they will have to speak with the minions. The minions will have to make 500-page reports, bring them back to the presidents. So, you know, it'll be it'll be 2011 again. If you remember in 2011, 2012, when we were trading, actually you were trading in between summits, because there was the Germans are going to do this, the French are going to do that. It becomes a Tower of Babel situation.
It's a central planning circus.
Exactly. So the way you have to think about it is the way in which you and I think about it. Is first, is the macro environment going in your favor as an investor relative to the risk of let's say political etc.? No, it's not. Is the inflation environment working towards you as an investor? No, it's not. Is the earnings environment helping you in terms of revisions? No, it's not either. So you are actually, as an investor, if you're taking the bet, you're actually placing, as in 2011, all of your bets in faith in the revived, you name it, in the bureaucrats doing what they were unable to do in 2009, 2010, 2011, 2012. So that becomes a very real risk. That is before we even talk about contagion risk.
Yeah,
the National Front in France, which is the lunatic populist extreme right party, which is about 30% of the vote in France. It's not small.
Yeah, they're doing really well over there.
This morning was calling for a referendum similar to this one in France. Now that's a big deal. In Holland, the radicals are also calling for a referendum. So you have a lot of things to add to your investment thesis apart from alleged valuations. No.
Yeah, once you go to Frexit and Spexit and whatever you want to, you'll have it. What you should do when I've already exited equity markets, but I think that should be the key word in your portfolio. You should have exited, the complexion of volatility risks that's associated with equity markets on this. But going back to, again, I think that once we get into the contagion debate, and Daniel, you and I could probably just talk all day about it, because at the end of the day, we would have an extreme amount of arrogance, probably close and approaching the arrogance of these central planners themselves, if we were to tell people specifically how the contagion ended. We have no idea. What we do know is the rate of change in the economy. And I think that what you said there is super important when you go back to either 2011 or 2008. In 2008, obviously, it didn't matter how many meetings they had. You could bring in Hank the Market Tank Paulson, you could have Bernanke there. They could do whatever they damn well wanted with a bazooka or otherwise. The economy was slowing, and that's why it didn't matter. In 2011, Bernanke, magically created this whole other super bubble economy. So obviously, you had them creating some kind of a stimulus into a tailwind of an economy that was a bubble economy, whether it was China or commodities or anything or otherwise. Now you have nothing. If you have, and just play this out from the former bubble, because that's usually where we have to start. If we take the down dollar bubble, so if we go to the lows of 2011, when Bernanke knew damn well that Americans don't understand what inflation is in dollars, he took the dollar to a 40-year low, he took gold to 1900, he took Caterpillar's margins to all-time highs. You had a super bubble in that kind of reflation of the markets. Now, if you play out the dominoes, I don't care what your scenario analysis is on the contagion risk. If it's down euro, it's up dollar. And that's what I'm worried about, because up dollar is down FTSE, up dollar is down oil, up dollar is down a lot of things that have worked this year. And I wonder how you, because I think most people may or may not know, by the way, that you're a former energy portfolio manager. So I think you have a pretty good take on how this could play through to a market that a lot of people are long right now, which is energy.
Yeah, well, obviously, in energy, you have two forces that always drive the performance of both equities and the commodities themselves. One is the monetary element that you just mentioned. The other, obviously, is supply and demand. Now, supply and demand, again, this is back to where we were talking before. Supply and demand is not working with you as an investor. Supply-demand scenario means, as from here, the world growth slowing further. We've seen the World Bank revise growth estimates to 2.4%. This means further. No matter how you want to look at it, even if you're mildly bullish about the market, there will be slowdown in investment, slowdown in consumption from where we are today. That's the most important thing. The second most important thing is that in the meantime, what we have seen is a lot of the bubble has been deflated in terms of the balance sheet. Therefore, so you've seen all the U.S. shale companies that have issued tons of equity, a lot of the risk. So what happens is that also the cost curve of the big producers has come down quite a lot. So what you're going to see again is an increase in supply, very similar to what we saw in 2014. In terms of so dollar up for sure, and you know why dollar up as well? Because every effort to increase monetary policy stimulus from the European Central Bank, from the Bank of England, especially now that it is perceived as a separate entity, and the Bank of Japan are deflationary inside their countries, as you very well know. Everybody was expecting some sort of reflation from monetary policy. Is actually the opposite, because money velocity collapses. So my point is that if you think of this as an event on its own that has been just a headline, and that the rest of the world is going okay, you have a problem in terms of both investment and consumption to support the fundamental thesis outside of the monetary one. And the monetary one is not looking at you, equity investor, not looking at you, in general, marketplace investor as the driving force. What it's looking at is, you mentioned, the bond market. Because where the big risk lies is in sovereign bonds that are at all-time lows, when deficits have continued to balloon, debt continues, and slowdown continues to be there. So the risk reward on that remains extremely, very tilted to the risk side. So all of the effort here is going to be to support sovereign bonds, and it's not going to be there to help you, as the Bernanke put did, because it is not going to generate a bubble that reflates growth perception.
Yep.
Why? Even if the European Central Bank and the European Union decide on a massive stimulus like in 2009, let's assume 3% of the GDP of the European Union, it's going to go to sectors that have today between 25 to 30% overcapacity. It's not going to generate jobs, it's not going to generate better earnings, and it's not going to generate better growth. It'll do something to support GDP, of course. GDP, the more you spend, you support it, but it doesn't do anything to consumption and to real investment, private investment, which is what matters.
Yeah, it's incredible when you talk about it in behavioral terms like that, and I think that this is really a moment for the central planners in that regard. I mean, because you hit a point, to your point, where if all they're really trying to do is keep bond yields low, that bond yields are starting to look like growth. They're both going down at the same time. That's when, historically, anybody who's studied markets past their nose understands that down bond yields equals down growth expectations, and eventually bad becomes bad. The Fed gets easy, and actually, in the last, I think we have it in slide. You'd have to pull up the slide deck, Josephine. I think it might be slide 64 or 5. But again, when the Fed starts to ease because they're corroborating or acknowledging that growth is slowing, the stock market starts to go down faster. The declines in the last 3 recessions have been between 20 and 57% from the S&P 500's top. So there's plenty of downside when you look at it in that regard. I think the bigger downside, though, is really on the behavioral point. I mean, Janet Yellen stated plainly in her most recent testimony that she doesn't think in rate of change terms, Daniel. She doesn't think in terms of headwinds or tailwinds. She just walks out there every day expecting sun, no humidity. I think she used to live in California. Maybe she still does now. Maybe that's her own problem. But the reality is that they don't think in rate of change terms. They don't understand that business decisions will change today. They don't understand that the entire kind of transmission mechanism that they created might be feeding back on itself. And that's really, I think, a lesson in Europe that's not new today, is it not? I mean, people have had to deal with this belief system breaking down in European equities all year long, have they not? This is just more of a really big down day.
Oh, absolutely. I think that the initial brouhaha of the QE generated a level of expectation that was based on, well, this is going to reflate inflation, is going to put growth back in the agenda, and is going to make companies invest more. As you very well say, it's never been a question of liquidity. Companies are not going to invest more when all of the price signals are perceived as artificial, and at the same time what they see on a daily basis in the economy in which they are creating jobs and opportunities is not improvement. It's not. Monetary policy becomes almost a self-fulfilling prophecy, because it's not that market participants, economic agents are not deciding to use low rates and high liquidity to deliver growth, is that high liquidity and low rates were never the issue. And that's what people don't want. They don't want to. It doesn't even matter if you and I say it, they don't want to accept it. And it comes from the following. Every time that they make an analysis, you see, in the last meeting, the ECB said, the problem in Europe is that the investment to saving ratio is too low. Investment is too low, saving is too high. Relative to what? Relative to 2007, Keith. 2007 was a bubble. Instead of saying, look, so either you're saying, hey, we want you to go back to the bubble of 2007, or you're basically just getting your information wrong about what the market is requiring, about both the transmission mechanism of credit to the requirements of the private sector, because you're just using a data point, 2007, 2008, that was simply lunacy.
Yeah, I mean, it's the definition of insanity, obviously doing the same thing over and over again, expecting different results. But it is embarrassing and at the same time sad that we will see nothing other than more ideological and dogmatic double downs on this from all these councils and all these meetings. So for me, like when I look and I want to get to some questions now because we have a huge dog pile of questions specifically for you. But you know, if I look forward today, like it's one thing to try to answer for a longer term investor, you know, what the Eurozone or the ECB for that matter looks like in terms of its impact in the next 3 to 5 years. It's entirely another thing for all the people who are under siege this morning to know what to do like right now. And how about on Monday? And that's when, don't forget, I just want everybody to be reminded of this very big component of U.S. equity demand in the marketplace has been buybacks. On some desks, you can go and you can see it's 20 to 30% of daily volume. Buybacks are blacked out next week. Got it? Hear me again. Buybacks. You got Brexit, buybacks, blackout. You got those 3 Bs? Line them up. B cubed. You have a very big problem here from a liquidity perspective, point number 1. Point number 2, earnings season. What do you think these companies are going to report? Again, these companies that are missing numbers already, the late cycle consumer credit companies that are most recently new, subprime auto, these are all American issues. How they're going to blame these British guys on that is going to be very interesting and entertaining. But the reality is that we have earnings season, which is a huge risk to the downside. And what kind of an executive, I have no idea, unless they just flat out lie to you. What are they going to say? Oh, Brexit's a great thing. It's great for the demand complex. You know, they're going to end up in a place now where I think earnings season, much like coming out of the end of December, coming out of the end of June, I think that the earnings season itself, which is really the mother's milk of a lot of multiple math and how people invest in equities, I think that that's the biggest risk. So anyway, that's just something that I just want to get off my chest before somebody asks about it. If you want me to repeat it, happy to repeat it. But I want to get some questions for maybe, do we have one for Daniel first?
Yeah, sure. I think we can put one in here.
Yeah, if you have a question, put one in. How do people that are new, how do they ask questions?
Sure, yeah. Great work, guys. This is actually one I think you guys answered pretty well, but let's try and get, so is Brexit a Lehman Brothers moment? For example, the psychological straw that broke the camel's back, or do we go back to a muddling at a lower level on the S&P? Maybe that's one.
I mean, I could do the S&P 500 question first.
Let's ask the.
What I'd say, and Daniel and I have both. This is why we get along so well. We understand that if you're still living in yesterday's crisis, particularly if you're one of the many economists, strategists, and government people and bureaucrats that miss calling every crisis, you're going to miss the one that you're in. I mean, this is a crisis. Daniel, tell me if you agree or disagree. But we're finally at the belief system breakdown. This is the crisis of central planners not basically being able to have people trust them anymore. That's what I think this one is. This is a lot bigger than Dick Fold when you think about it in that regard, because there are many more people that are invested in that belief system, either financially or politically, than at that point. It was very different. I mean, every crisis is different, is it not?
Absolutely. That is the question as you very well say, is based on the previous crisis. This crisis is because people are realizing that Father Christmas doesn't exist. It's simply that. We have been told a full generation of traders has only seen expansive monetary policy and only knows to buy the dip is the policy. So what we're here facing is when the period in which, when you're a kid, you start to sort of be uncomfortable with the idea of Father Christmas. You start to be a little bit suspicious because you see your father wandering around the garage. But at the end, but this is
Father
this,
Christmas.
today is when you realize he doesn't exist, and that's where you realize why, because you've heard the word unlimited and your portfolio is down between 10 to 20% with unlimited liquidity. And that's
It's incredible. I mean, Josephine, if you can go to, can you get the slides up, or can we not do the slides right now? Like, this is usually how I go to this damn data, Daniel. It gets people every time. If you go to the slide 38, where the belief system, the theme breaks down, I can do this in like 90 seconds or less. Just start with the question slide, Josephine, if you can, because this is really the whole. I mean, you'll know what I'm talking about without even seeing these slides because you can't see them. But what happens when you combine? Next slide. Negative interest rates. This is ECB and BOJ deposit facility rates we're showing, Daniel, because you can't see these slides, with quantitative and qualitative easing as far as the eye can see. So we're showing you the ECB balance sheet to date in year-over-year change terms and the BOJ's balance sheet in rate of change terms. By the way, the BOJ is doing 80 to 90 trillion of this. And since that didn't work, they have to combine it with that last slide. Go back to it one more time. It's not quantitative, it's qualitative. Now that we've done everything that we have and it's unlimited, now we have to start walking the markets towards negative interest rates. So what we're showing you here, forward guidance, what basically happened was that we're showing you 2-year overnight index swap rates here, Daniel. This is where in February and January, both Eurozone 2-year OIS and Japanese 2-year OIS started to break down, and the bank stocks started breaking down with it. And that's really that's the bugaboo, isn't it? Where the bankers are screwing the bankers. I mean, the actual communication, now that it can only be qualitative, Janet Yellen can only hurt Jamie Dimon's earnings.
Yeah, well, absolutely. And if you remember, when the ECB gave its last speech, a few of the bankers in Europe gave press conference, whatever, saying banks are really suffering in this environment, blah, 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 blah. And the response was immediate. The response was, you have to deal with it first. Second, find your way to merge or something like that. Now, all of that is saying to me is that the transmission mechanism is going to continue to deteriorate. And that the transmission mechanism is deteriorating both because the monetary policy is looking at figures relative to GDP that are simply unimaginable, and on the other side because there is not enough demand for credit to absorb all that expansion of monetary policy. So that's why inflation expectations will continue to come down and growth expectations will continue to disappoint. And you've mentioned earnings. We've had 5 consecutive years of no earnings growth in Europe. 5 years. This is not just something that, it was last year, it was the crisis. No, you've had everything. Recovery, you name it. 5 years of consecutive no growth. And so this is the issue. This is, again, coming back to the analogy of Christmas. What you have to believe now in order to surmount your previous suspicions and the fact that you see your father wandering around with a few boxes is, I don't know. It has to go beyond anything that existed before. So it's impossible to rebuild the trust in the old methods. That's why I'm afraid they will go.
Yeah, that's a
through
huge component.
stagflation formula, the stagflation formula, which is helicopter money.
It's kind of interesting that the duration of your, and I love how you call him Father Christmas. I mean, most Americans call him Santa. I mean, I'm French Canadian.
I forgot.
I'm French Canadian. No, you shouldn't forget. I mean, Le Père Noël, huh? Où est le Père Noël? You come out of the garage sometimes, and you know it's your uncle, and he's hammered, and it's been like 7 years, and you've been sitting there dealing with this quantitative easing crap like you've believed it until you get your present. And that's the point. I think here we are. People don't have a present here. Just to give people an update, S&P 500 down 57 handles on the open. I think people are trying to buy this damn bounce. I mean, people are going to get their faces ripped off, I think. They've already gotten them ripped off. I guess you have to do the double rip-off like Nicolas Cage style. But here we are. No matter where you go, that's what it is. The banks are leading the decline. So if you look at KRE, which is the regional bank index in the U.S., Daniel, that's down 6% on the open. The financials, XLF, is down almost 5%. Volatility is the key, though. Volatility both, and this is really interesting relative to the kind of back and forth on the dollar that we had relative to the reflation trade. Oil volatility has spiked. OVX has spiked back up to 45 here, Daniel. And you have U.S. equity volatility kind of in and around 24, 25. I mean, they could take U.S. equity volatility to 35, 40, no problem. And what's going to be really interesting, I think, and we try to focus people on this in market moments like this, because obviously we're long TLT, which is up 3% right now. It's probably the best day in my personal account's life, by the way, so I'm not going to apologize for that. Gold's having a great move. But what is going to change that? Like, what is really going to change that? I guess some people, Daniel, would be concerned if they're long bonds, particularly the ones that have negative interest rates now, that now that they have negative interest rates, that the best of the bull case is behind them. Do you think that could turn, or they're just going to keep those European rates super low, and I get paid on the long side of the long bond because there's so much downside? I mean, the 10-year bond yield in the U.S. could break through 1%. I mean, there's nothing but net underneath that Santa Claus, Père Noël, or whatever you want to call Happy Christmas. I mean, there's a pretty happy day today if you're long bonds.
No, absolutely. Well, first, I think that the reason why you would be concerned would be if you thought that monetary policy has reached its peak, and that is incorrect by all means. They can do a lot more, unfortunately, and they can. And you have many economists out there, unfortunately, also very close to governments, calling for further financial repression as a solution. So not just talking about zero interest rates or mildly negative real interest rates, but absolute negative interest rates. So, and I believe it was one of the U.S. investment banks that mentioned -3% as the solution. Of course, if going from 5 to 0 didn't work, I'm sure from 0 to -3 will be the solution. But so I don't think that the long bond trade is going to end anytime soon for a very, very particular reason. There is just one thing that every policymaker is thinking about right now. We will not have a credit crisis, a CDS rocketing crisis. So that's when they talk.
Because they really do live in the old crisis. They're going to make sure of that, or they think they're going to make sure. I mean, obviously.
Exactly. So what they will be trying to prevent is the old crisis, and as such, the long bond trade is likely to continue to be extremely well supported. Also, from the fact that companies on the corporate side have been hoarding cash, reducing investment, and their ability to repay their debts is their top priority. Now, because they will be looking at the previous crisis, and they're not looking at what this crisis is, which is the clear saturation of monetary policy crisis, what they will not be looking at is what drives. This is the key thing that you and I will not hear from any central banker talk in the next year. Money velocity is our key metric to monitor. We need to our monetary policy and our policy as a government, etc., will be based on rate of change improvements in money velocity, because any other thing is going to get us deeper into the crisis. And I think that that's and instead of looking at it from the perspective of savers consuming more, companies having better opportunities to invest and to hire people, they will be looking at it from the perspective of governments reaching unheard of deficits to support GDP. That's my concern.
Yeah, it's a very important concern. It's going to be ongoing. And just to give people, again, levels update before Ben asks the next question, I have immediate term downside for now, 2039 in the S&P 500. But again, that's a stopping point. Don't forget that there's a lot of experience here sitting between Daniel and I. You got over 40 years of market experience. I don't want to date you, and I'm using a conservative estimate there, Daniel. Don't worry. The reality is that we've done this before. In the first 20 minutes of trading, you know what you do in a moment like this? Nothing. If you're positioned for it, absolutely nothing. This is going to be, again, a lot of emotion in the first 20 minutes of trading. I usually wait till at least 9:50, and then we start to see the big money start to make some decisions. It's going to be really interesting. There's been a lot of problems out there from a performance perspective already before this move. If Josephine, if you could show futures and options contracts positioning for people that are new to how we've looked at the world. A friendly reminder that coming into this week, I don't know if you saw this or not, Daniel, but S&P 500 index and E-mini options, the net positioning was the longest, the biggest net long position in a year. So if you look at that, even on a relative to a 1-year Z-score, the standard deviation of the position relative to itself, that's just an incredible, to me, it's an incredible manifestation of how much people have no idea what's going on. They were so willing to chase the rabbit. Betfair should go bankrupt, by the way. I mean, you got people that were basically buying S&P futures up 20 yesterday, Daniel, in the morning, because whoever jigged the Betfair bet, was probably long the spoos. I mean, this is a really interesting, time for people like us who've traded markets for a long time.
Completely, and I encourage anyone that's unless you're a massive firm and you don't care, but I encourage anyone to do exactly what you've just said, which is be extremely cautious. The first thing you have to do, I've traded all my life, many, many years. I don't want to say the number you said again, that gets me depressed. 40 years in total, but never double down on a Friday. Never double down on a Friday, on any Friday in general, this Friday on top of it, because on top of everything, you have Spanish elections.
Oh man, we didn't even talk about that. I mean, I got the Spanish guy. I don't have Father Christmas here. I have the best Spanish strategist right here, and it took until, I apologize, I make a lot of mistakes, obviously, I'm a little thick up top, but what the hell happens in Spain on Sunday?
Well, this is the key. This is the thing, is that it is likely to be a very similar result as the one we had in December. Unfortunately, it's going to be a more radical result because the populists are likely to overtake the position of the, let's say, more moderate socialists. For any American listening, any of them is a communist. But in Europe, in socialist Europe, there are moderate socialists. So it is very, very likely that there will be a very, very polarized parliament, but with no clear majority. So this adds to the uncertainty, because it is very, very likely that you will have, again, months before you have a clear view of who will be leading, and what will be the coalition that will be in government.
Yeah, I mean, again, confusion. Daniel gave you a great risk management point. On a Friday, particularly when we have a moment like this, do nothing, wait and watch. But when confusion breeds contempt, and it's a political catalyst that you have no clarity on, you may be waiting for a lot longer than you think. It could be a very long summer here, guys. Let's take another question while we have time.
Sure, yeah. Next one, Daniel, for you. Moving, do you have an expectation, or do you have a few scenarios coming out of the G7 meetings this weekend?
All right.
Well, yes, I think that they will give vague messages about spurring growth, about governments doing more to uh, to help investment and to combat the slowdown. I think that there will be definitely a message of union in terms of we will do everything to support the financial system in general with liquidity and with central bank coordination. That's for sure. But very little more. There's going to be very little more than that. Growth expectations obviously been slowing down, and we still have to see the revisions of both India and China. And the message will be of trying to give some level of comfort about being united in monitoring the situation.
Interesting. I'm getting a couple questions here, guys, on gold, just to give you levels. I mean, what is clearly bullish in as much as Europe is bearish? When something's breaking down, very basic risk management lesson, in addition to the ones that Daniel just gave you. Again, when something is breaking to lower lows on accelerating volume, and there's a real reason why, that's very bearish, okay? Don't be Captain Value Buyer. There's no heroes in our profession. That's in the movies. If you want to do that, or if you want to go on TV, you go. There's plenty of opportunity. There's not a high bar in terms of competition there. If you want to get good at this, lower lows are bad, higher highs are good. What's making a higher high tier today instead of the long bond? Gold, big time. And it's making a higher high within the context of nothing but upside back to 2011. And again, that's a really big deal for gold to be going up here with the dollar up a full 2.5–3% on the U.S. dollar index. This is getting real, guys. This is a real deal. Any questions on something other than gold?
For levels wise?
No, just like something for Daniel, hopefully.
No, we do. This is an interesting one. Would further stimulus give other EU members more of a reason to exit as well? Does further easing become a threat to lose more members? So I guess the takeaway is more of the same. Is more of the same going to spur potential exits from other countries?
The interesting position here will be that of Germany, because at the end of the day, take away the UK, you have France and Germany basically paying for the party of everybody else. So you have to, it would be interesting to see what are the messages coming out of Germany. I'm interested in one word, Eurobonds. I'm worried that the message that will come across to policymakers will be that it's all an issue of sharing risk and again joining together and putting a shield and think that a Eurobond issue will be the whole solution. In any case, well, I think that what would trigger another country deciding to leave would be actually if the messages coming from the European Union were of digging the hole deeper, in becoming even more rigid, even more interventionist. That could definitely trigger a negative response from Holland. We talked about it before. Maybe from Finland. Maybe from other countries that have more of an Anglo-Saxon free market trade culture. I think a key point here. Sorry to continue. A key point here will be how they deal with the issues of bilateral agreements with the European Union, with the European Union that has, country by country, many of them, a trade surplus with the UK. So imagine that they decide to go aggressive on the UK, but you have a very strong surplus, a very strong trade relationship with the UK. Those countries will feel that they are double impacted by this situation.
Yeah, and to your point, culturally, there's a history there. I think that a lot of people, it's kind of interesting when you get a lot of people that haven't traded a market in their life, which was the case last night, were trying to report on what was going on. I don't want to name names, but you're in a place now where everyone has an opinion on this, Daniel, and it's very political. So what you'll see is a lot of American political pundits, particularly those on the left, are very much for Remain, and everything they talk about on the Leave camp has to do with either racism, xenophobia, they're not talking about what you just mentioned, which is a very important point. There are a lot of free market capitalists in the North. There are a lot of them. This is where part of it was born, McFly. I mean, this is where we're at. So
absolutely.
I'm not voting for that.
The whole debate. There's been an issue of immigration, of course there is, but the whole debate has been about, and I quote, the creation of a super state that intervenes on every economy, and that the countries involved have nothing that they can do with their own sovereignty to avoid that. The words superstate and interventionist are coming up over and over and over again. And again, it's a matter of fact. The parties that have defended Brexit, like the ones that are defending the possibility of a referendum in those countries, are parties that are fully in favor of TTIP, of the bilateral agreement with the US, fully in favor of more commerce, of more open trade, they're free market defenders.
It's to me, I just that's why I think it's such a hard thing to answer the further out we go in time. And we're talking like a very small capsule in time when we talk 1, 3, 5 years from now. If we go back 200 years, this is just getting started. It really is. You have so many people who have no idea, zero, negative, who have money, by the way, have no idea how macro markets work. They have no idea how the free market capitalist system, built a lot of what they're sitting in when they sit in their homes. They are sitting there having a moment that they don't even understand they're in. And that, to me, that's the Big Bang Theory, and it could be a good one in terms of I'd love to go to the UK and buy a bunch of Trump's golf courses at a very low price. I don't know if it's going to happen. He's clearly marketing his golf course today. But the reality is that there's a lot to do when price is clear, and it's the free market capitalists that are going to do it, not some guy on MSNBC. Next question?
Yeah, sure. This is probably one for either of you. You hit on this earlier, Daniel, but this is an important kind of question to ask in cause effect and kind of traditional. And centers around traditional monetary policy. Why, following monetary stimulus, has the velocity of money actually gone down?
Oh, it's very simple. How do you think about the words financial repression? Financial repression doesn't make you take more risk; it makes you be more prudent. Think about why the Japanese consumer, evil Japanese consumer, doesn't do what the central planner wanted him to do or her in the last 19 years with negative or zero interest rates and 6 consecutive stimulus. It's because they're not amnesiac. So the reason why people don't take more risk, especially in the real economy, is because the risk reward is completely mismatched. It's completely mismatched. And companies, families understand it. You save more. You don't save less. You buy more. You buy negative yielding bonds instead of going and buying French equity that yields 7%. You become a lot more prudent, and slowly money velocity simply goes down because the increase in a money supply relative to the growth of real GDP cannot be matched even by the most megalomaniac investment desires. Put it this way. Think about what Larry Summers was mentioning about the secular stagnation. No? If you put together all the investment requirements of the world as considered by the World Bank, you don't get to 1 year of increase in money supply from the ECB, the Bank of England, and the Bank of Japan. I'm talking what the World Bank, obviously very optimistic and very diplomatic, always inflating figures, nothing bad about it, is considering for the next 30 years. So the problem that you have is not a question of that money velocity goes down despite monetary policy, is that monetary policy is adapted to try to recreate a world that was a bubble. That's what we talked about before, and that's why money velocity collapses.
And that's the key, and maybe a spot we should wrap up here soon. But I mean, that's a key, really kind of the fulcrum point of how we talk about where we are today from a crisis management or a central planning demand perspective, is that it's not the 1990s. Anyone who's studied demographics, you can look at, actually, Joseph, you show up slide 54 and 55. We show the demographic decline in Europe and in Japan is not going to die. Perversely, unless you were to have people die a lot faster, there's no way to change the 35 to 54-year-old population, which is the main spending cohort, which is effectively crashing into negative territory. There is a hope that one day on slide 55, the US, the millennial population picks up that curve. But my main premise here is in the red box in the US, the baby boomers have gone from 1 to 2 to 3 homes to 1 to 5 cars, whatever it is, with leverage in the 1990s during the best of times, to us trying to replace organic growth with levered expectations that the central planners can replace or recreate organic growth with leverage. It's the most dangerous promise. It's the biggest dogma. And again, as the world starts to figure out that they can't solve for gravity and time, I would be very, very concerned if you don't have the position that's being paid out today, which is long growth slowing, that's basically long the long bond, long gold, long anything that looks like a bond or a safe yield, because all the other stuff is what's been levered up. I mean, you look at what's happened to Bill Ackman or what's happened to some of these stock pickers out there whose basic premise is, I'm going to do what everybody else does, but with leverage. Leverage is a big issue when leverage is starting to come into question here. So that's just something that maybe I wanted to try to finish on. Markets are going to try to bounce here, Ben. They're going to try to bounce them.
I'm sure.
They're going to have G7 meetings. They're going to have, like as you said, Daniel, they're going to have meetings as far as the eye can see. And it's going to be more meetings and meetings after that. Maybe it's good for the roadshow chicken business. I don't know. These guys are going to have a lot of room service. They're going to have a lot of what's going on in central planning land, but that's not what's going on in the real economy. I wonder if you had any parting thoughts so that we can get back to doing the other stuff.
I think that think about 2011, guys. Take it as it is. You're trading a market that will give plenty of opportunities. But take any rebound to reduce exposure to cyclicals. Some people are trapped there. You reduce exposure to cyclicals, improve your positioning in the bet of inflation slowing down, growth slowing down, the earnings season not going with you, and take it with a lot of calm, because messages from politicians, like in 2011, like in 2012, don't generate growth. They generate just basically trading points.
That's great. It's great advice. I mean, improve your position, Daniel said. Improve your position. If you don't have the best position, you know what? You should have the best position. We should be excellent at our job. We shouldn't make excuses. We shouldn't complain. We shouldn't whine. We shouldn't tell people what to vote. This is a democracy. So again, improve your position if you don't have the right position. Don't hope that the position that you had, the wrong position, is going to improve with some central planner's waving of a wand. If you're doing that, I think you're going to make a huge mistake. I think Daniel agrees with me, and I think it's a good time to sign off.
Okay,
here for
great.
The macro
Thanks,
show.
Keith. Great discussion.
Thank you
Daniel,
so
thanks
much.
so much for joining us. We really appreciate you coming on.
Absolute pleasure as always. Best of all.
Okay,
Have a great
thanks.
weekend. Bye-bye.
Good luck, everyone out there today.